Assalamualaikum and a very good day to all beloved Madam Zaibedah binti Zaharum. My name is Siti Damia binti Muhammad FARIHK with my two other group mates KAUTHAR binti BAHARUDin and MOHAMAD RHOHAIMEY bin ROSLI. Today, we will be presenting a trend and comparative analysis of financial performance between Apex Healthcare Berhad and World Pharma Biotech Berhad. This analysis covers data from 2020 to 2024 with a detailed comparison for the year 2024. This presentation aims to evaluate and compare the financial performance of Apex Healthcare Berhad and World Pharma Biotech Berhad using key financial ratios. These ratios help us to understand the profitability, efficiency, liquidity, and financial risk, allowing stakeholders to make informed decisions. Before we move further into the presentation, let's take a look at the company overview for both Apex Healthcare Berhad and World Pharma Biotech Berhad. Healthcare Berhad is a Malaysian-based pharmaceutical group founded in 1962 and listed on Bursa Malaysia. This company operates in manufacturing, marketing, distribution, and research and development of pharmaceutical products and medical devices, with operations in more than 20 countries. This company's motto is "Restoring Health, Enhancing Life," reflects its commitment in improving healthcare outcomes. Pharma Biotech Berhad is a leading Malaysian pharmaceutical company listed on Bursa Malaysia since 2002. This company focuses on manufacture and distribution of generic medicine, biologic product, and health supplement, with a presence in over 30 countries. This company's motto is "Smarter Solution, Healthier Life," highlight its focus on innovation and public health. Now, let's look at profitability ratios of Apex Healthcare Berhad. First, profit margin ratios. Profit margin ratios shows how much profit the company earned from its sales. Apex recorded the highest profit margin in 2023 at 42.51%, while the lowest was in 2021 at 7.71%, indicating that profitability peaked in 2023 but much lower in other years. Next, return on asset. Return on asset measure how effectively company uses its asset to generate profit. The highest ROA was recorded in 2023 at 35.45%, showing efficient asset utilization, while the lowest was recorded in 2024 at 7.59%, reflecting weaker asset efficiency. Apex achieved its highest ROE in 2023 at 43.34%, while the lowest ROE was in 2024 at 9.69%, showing a significant drop for shareholder return.
Now I will explain asset utilization ratios. Asset utilization ratios show how efficiently Apex uses its assets to generate sales and cash. So first we have receivable turnover. It measures how fast the company collects money from customers. So the higher is better. Apex recorded the highest receivable turnover in 2020 at 5.50 times and the lowest in 2024 at 5 times. So it's faster in earlier years but slightly slower in 2024. Next we have average collection period. It measures how many days Apex takes to collect payments. A lower number of days is better. The lowest SCP was in 2020 at 67 days and the highest in 2023 at 75 days. But in 2024, Apex improved to 68 days. Next is inventory turnover. It measures how quickly the company sells and replaces its inventory. So the higher means faster sales. The highest recorded was in 2021 at 8.08 times and the lowest was in 2024 at 7.26 times. Next is fixed asset turnover. It measures how efficiently machines and equipment are used to generate sales. The highest recorded was in 2023 at 4.70 times and the lowest was in 2024 at 3.76 times. This shows that fixed assets were used most efficiently in 2023. Next is fixed asset turnover.
For this slide, I will be explaining the liquidity position of Apex Healthcare Berhad over a 5-year period from 2020 to 2024. First, let's look at the current ratio. From the chart, we can see that Apex current ratio fluctuates over the 5 years. In 2020, the ratio was 2.81, increased slightly to 2.97 in 2021, then declined to 2.72 in 2022. The highest current ratio was recorded in 2023 at 3.70, indicating that Apex had strongest ability to meet short-term liability during that year. In 2024, the ratio decreased to 3.31, but it is still at a healthy level, showing that Apex remains capable of covering its current obligation. Next is the quick ratio, which excludes inventory and focus on more liquid assets. In 2020, the quick ratio was 2.16, increased to 2.34 in 2021, then slightly dropped to 2.07 in 2022. Similar to the current ratio, the highest quick ratio was recorded in 2023 at 3.03, showing that Apex has strong liquidity without relying on inventory. In 2024, the quick ratio declined to 2.5, but it still reflects a solid liquidity position. To debt utilization, the first one is the debt to total asset ratio. This ratio shows how much of the company assets are financed by debt. From the data, we can see that the ratio was relatively stable from 2020 to 2022, staying around 24% to 25%. In 2023, the ratio dropped significantly to 18.20%, which is the lowest among all the years. This indicates that Apex Healthcare relied less on debt and had better control over liability in 2023. Although the ratio increased slightly to 21.73% in 2024, it is still lower compared to earlier years, showing a healthy debt position. Next, I will explain the time interest earned ratio. This ratio measures the company ability to cover interest expenses using operating income. The results show a strong upward trend from 2020 until 2023. The highest value was recorded in 2023 at 155.27 times, while the lowest was in 2020 at 54.71 times. This means that in 2023, the company had a very strong ability to pay interest expenses, indicating high profitability and low financial risk. In 2024, the ratio decreased to 80 times, but it is still is fixed coverage ratio. This ratio indicates the company ability to pay fixtures such as lease and interest expenses. The company recorded its highest fixtures coverage in 2023 at 121.33 times, showing excellent financial strength. The lowest value was in 2021 at 25.1 times. Lastly is fixtures coverage ratio. This ratio indicates the company ability to pay fixtures such as lease and interest expenses. The company recorded its highest fixtures coverage.
In this analysis, we compare financial performance of Apex Healthcare Berhad and Duo Pharma Biotech Berhad for the year 2024. Let's begin with profit margin ratio. In 2024, Apex recorded a slightly higher profit margin of 7.96%, while Duo Pharma reported 7.69%. Next, we move on to return on asset. Apex achieved a significantly higher ROA of 7.59%, while Duo Pharma recorded 4.54%. This indicates that Apex is more effective in utilizing its asset to generate earnings compared to Duo Pharma. Lastly, return on equity. Apex again shows stronger performance by recording an ROE of 9.69%, which is higher than Duo Pharma 8.83%. This means Apex generates slightly higher return for its shareholders and utilize its equity more efficiently. In summary, across all three ratios, Apex Healthcare Berhad show better financial performance compared to Duo Pharma Biotech Berhad in 2024. Lastly, return on equity. Apex again shows stronger performance by recording an ROE of 9.
Now let's compare Apex and Duo Pharma based on asset utilization ratios for 2024. So first is we got average collection period. In 2024, Apex recorded an ACP of 68 days, while Duo Pharma at 86 days. So Apex collects payment faster than Duo Pharma. Next is receivable turnover. In 2024, Apex recorded at 5.0%, while Duo Pharma at 4.41%. Okay, now let's compare Apex and Duo. Next is inventory turnover. In 2024, Apex recorded at 7.26 times, while Duo Pharma recorded 3.27 times. This shows that Apex sells and replaces its inventory faster than Duo Pharma. So next is fixed asset turnover. In 2024, Apex recorded at 3.76 times, while Duo Pharma at 1.43 times. So Apex uses its fixed assets more efficiently. And lastly, we got total asset turnover. In 2024, Apex recorded at 0.95 times, while Duo Pharma recorded at 0.59 times. This shows that Apex is more efficient in using its total assets.
Now I will be presenting a comparative financial analysis between Pharmaniaga Berhad and Apex Healthcare Berhad for the year 2024. This analysis focuses on liquidity ratio and solvency ratio to evaluate the financial performance and risk level of both companies. First, let's look at the current ratio, which measures a company's ability to meet short-term obligations. In 2024, Duo Pharma recorded a higher current ratio of 4.08 compared to Apex with 3.31. This shows that Duo Pharma has stronger short-term liquidity, meaning it is better positioned to settle its current liability and face lower short-term financial risk than Apex. Next is the quick ratio. Duo Pharma again performed better with a quick ratio of 2.68, while Apex recorded 2.5. This indicates that Duo Pharma can meet short-term obligations more effectively without relying on inventory, showing slightly stronger liquidity management. Moving on to debt to total asset, which measures the proportion of asset financed by debt. In 2024, Apex recorded a lower ratio of 21.73% compared to Duo Pharma higher ratio of 48.53%. This means Apex relies less on debt financing, making it less financially risky, while Duo Pharma carries a higher debt burden. Next, we have the time interest earned ratio, which shows how well a company can cover its interest expenses. Apex required a very high ratio of 80 times, while Duo Pharma only required 3.78 times. This indicates that Apex has a very strong ability to pay interest and therefore face very low risk of default, where Duo Pharma ability is comparatively weaker. Lastly, the fixed charge coverage ratio measures the company's ability to cover its financial commitments. Apex again outperformed with a ratio of 22.5 times compared to Duo Pharma 3.78 times. This shows that Apex is much stronger financial position when it comes to meeting fixed charges and has a lower long-term financial risk. In conclusion, Duo Pharma performed better in liquidity as shown by its higher current and quick ratio. Apex performed better in solvency and financial stability with lower debt level interest and features coverage.
Okay, for significance and importance, I will explain who uses these ratios and for what purpose. For profitability ratios, first we have profit margin ratio. It's used by investors and shareholders to see profit consistency, and used by banks to judge loan repayment ability. Next is return on asset. It's used by management to check asset efficiency, and used by directors to monitor long-term performance. And the last one is return on equity. It's used by investors and shareholders to evaluate returns, and used by financial analysts to compare companies. For asset utilization ratio, first we have receivable turnover. It's used by management to check how well customers pay, and used by suppliers to see if the company can pay on time or not. Next is average collection period. It's used by management to monitor how long customers take to pay, and used by suppliers to judge cash flow. Next is inventory turnover. It's used by management to manage stock and avoid overstocking, and used by investors to assess product demand. And after that we have fixed asset turnover, used by management to check if machines and equipment are fully used, and used by investors to see how well the assets generate sales. And finally we have total asset turnover. It's used by management to evaluate overall efficiency, and used by creditors to assess repayment ability.
Moving on to liquidity ratio, the first one is the current ratio. Current ratio measures a company's ability to pay short-term liability using short-term asset. This ratio is useful to investors to assess financial stability and liquidity risk. For management, it helps decide how much working capital is needed and whether the company is over-liquid or under-liquid. Next is the quick ratio. Quick ratio measures a company's ability to pay short-term debt using its most liquid asset, excluding inventory. Banks prefer this ratio because it is immediate liquidity. Management uses it to monitor cash, receivable, and shortly, features coverage. It measures the company's ability to cover its financial commitments using operating income. This ratio helps investors assess long-term financial stability and risk exposure. For management, it indicates whether its commitments are too high relative to earnings. Lastly, features coverage. It measures the company's ability to cover its financial commitments using operating income. This ratio helps investors assess long-term financial stability and risk exposure. For management, it indicates whether its commitments are too high. We have debt utilization. Debt to total asset, it measures the proportion of company asset financed by debt. This ratio indicates that financial risk associated with borrowing. Investors use it to assess long-term stability, while management use it to determine the right balance between debt and equity financing. Next, we have time interest earned. It measures the company's ability to pay interest expenses using operating profit. This ratio is important to credit rating agency when assigning credit rating. Management use it to evaluate the burden of debt and interest of.
First, profitability ratios. APEX shows stronger and more consistent profitability based on profit margin, return on asset, return on equity, and return on turnover. Pharma, however, show weaker and less consistent profitability, indicating challenges in generating return from its asset. In terms of future outlook, APEX is expected to grow steadily, while Duo Pharma need to improve its profitability and efficiency to avoid potential decline. Moving on to asset utilization ratios. Apex demonstrates better efficiency in managing its assets, including receivables, inventory, and fixed assets. In contrast, Duo Pharma experienced lower collection periods and lower assets productivity, which affects its operational efficiency. Looking ahead, Apex is likely to maintain stable performance, whereas Duo Pharma needs to enhance its assets management to improve future effectiveness. For liquidity ratios, Duo Pharma shows stronger short-term liquidity compared to Apex. Although Apex has lower liquidity, it operates efficiently with relatively low financial risk. In the future, Apex can remain stable with proper liability management, while Duo Pharma liquidity position may weaken if debt continues to rise. Lastly, we examine debt utilization ratios. Apex shows a high level of debt but manages it effectively through strong and consistent earning. Duo Pharma, despite having lower debt, is less in generating returns. Moving forward, Apex is expected to remain financially stable, while Duo Pharma must carefully manage its debt to reduce financial risk.
Overall, in 2024, Apex Healthcare Berhad performs better in profitability and asset efficiency, while Duo Pharma Biotech Berhad performs better in